Happy Canadian Thanksgiving for the Canadians and happy Columbus Day for the Americans. It's October the 13th before the market opens. Last week we saw some crazy stuff. On Friday in particular, we saw the market respond negatively to Donald Trump's post, ratcheting up tariffs on China. And we'll get into that in a minute, what it might mean for the markets. Probably not as bad as it seems, but we'll talk a little bit about that as well. We'll talk about the earnings season coming up because this is an important one. And we'll talk about the sector performance in the markets, take a look at some currency performance right now for the Canadian dollar versus US dollar versus world currency. A little bit of seasonality there. We'll also take a look at the sector performance in the markets last week and what it might be indicating overall. So let's start by taking a look at what happened on Friday with Donald Trump's post. We saw him put out a post and talk about very strange things that are happening in China. And basically what he said was China was sending out letters to countries throughout the world imposing export controls. And this was in regards to rare earth elements. And so they're trying to stop other countries from exporting rare earth elements to the U.S. indirectly. Now, this obviously upset Trump, and he came out and said, we're going to put 100% tariffs on this, and that, etc. Now, the next round of tariffs are supposed to be negotiated or bumped up. I think it's around November the 9th or 10th. And Trump is supposed to actually be going over and meeting with Xi as well. So it was really interesting. Now, I want to say as far as this goes, that Xi knows and China plans long-term. So this isn't just something they just did. And so there's a couple possibilities here. One is they thought they could just get away with it. The other one is that this was a bargaining position with the U.S. and they were flexing their muscles ahead of the next round. And the third one is that they really want a trade war. And I would say it's probably the second, that in this case, that they're really flexing their muscles to say to the U.S. that they actually have some bargaining power here in these negotiations because the U.S. needs rare earth elements. China mines 70% of the world's rare earth elements and refines 90% of the world's rare earth elements, and they go into things like computers, jets, missiles, etc., etc. So this is a really critical thing that's actually taking place right now. On the weekend, we saw Trump come out and say, "Don't worry about China. It will be fine. Highly respected President Xi has had a bad moment." He's trying to say, well, we should be able to work things out here. So maybe things aren't quite so bad. But this is really some flexing going on. And China, I think the U.S. does have a bargaining position over China based upon exports and imports between the two countries, et cetera. And in other words, the U.S. can do a lot more damage to China in a trade war than China can do to the U.S., yes. But there's one part of this a huge matrix of operations of exports and imports that China actually has control over, and that is rare earth elements. I came across this meme, and it does apply to this current situation. Here's Trump saying, "I hold all the cards." And here's Xi coming back and saying, the cards are made in China. And this definitely applies to the rare earth element situation. China does have this one part of the bargaining power as far as the negotiations go with the trade wars. We're going to have to see what happens. Right now, I think investors are just saying, well, we really don't care about trade wars. Don't forget that we're seeing the court situation as far as the U.S. goes now. There's been appeal courts that have ruled that the U.S. tariffs are illegal. And now this is going to the Supreme Court, and that's going to happen a little bit later on in November. And that could have an impact. We don't know when we'll get a decision as far as that goes, because in theory, that means that the U.S. would have to give back all the tariffs. Now, Maybe they come up with some sort of creative solution and say, well, you have to donate the money to us if you want to trade with us. I don't know. But they say that they have tools in the toolbox if they lose the case. But we'll have to see. But right now, investors are saying, well, we just don't care. It was a little bit of a shock on Friday. But right now, I think we're going to see at the beginning of next week, or beginning of this week, I should say, we'll probably see a positive start to the week. But there are other factors coming up, such as earnings. Okay, let's take a look at what happened last week in the markets. Here's the S&P 500 down 2.4%. I want to point out the utilities was up 1.5%. Now, this is the defensive sector, but it often acts as a risk sector as well. In the last couple of years, when the market goes down, it tends to go down, but it didn't. It did quite well. And we saw the consumer staples sector up. So in general, we saw the defensive sectors actually perform quite well. This is really important because what that means is that investors, yes, the market went down in almost all the sectors, but the defensive sectors did relatively okay. In other words, investors weren't bailing on the market. They still wanted to be invested, and that's important. Here's some more markets here. You can see the NASDAQ was down approximately equal to the S&P 500. Small caps down a little more. And we saw emerging markets do okay last week, and the TSX was down just a bit less than the S&P 500. Here's some key sectors. Uranium on fire. Yes, we saw uranium do well for quite a few months, went into consolidation phase, and is back on fire again. Metals and mining was up last week, and when you see metals and mining up, and it'll often translate over into uranium doing well. We saw silver up 4.4% on fire. Up, closed over $50. We'll take a look at that. Gold closed above $4,000, all-time high. This excitement just keeps going for this sector. We saw retail underperform. Numbers for the bottom income earners just are not good as far as spending goes. Home builders really need to see a drop in interest rates to really boost that market, because if the numbers aren't good for this group, then overall, it's going to be harder for people to buy a house. We need to see interest rates drop a bit before we can really make a strong argument for this improvement in the sector. Nat gas, it was performing well, but performed a little bit weaker last week. Overall, this I find interesting. U.S. banks down 5%. Now, they're kicking off the earnings season this week on Tuesday, October the 14th, and they're down. So typically, you'd like to see the sector going up before the announcement of earnings to show some confidence in the sector. Really interesting. Here's the Canadian market down 2% overall. The utility sector, once again, this was a defensive move. We saw actually fairly broad-based performance there for the utility sector. Investors become very defensive, and we saw the sector perform well. Communication services, that was more Rogers affecting that. Overall, technology was down quite a bit as well. I want to show you this table here. This is the S&P 500 on Friday, and only Friday, so October 10th. And here it's ranked in the order of gains for the day. This is the 1 day, and this is for 5 days right here. I want to take a focus on this column for the 1 day, for Friday. And if we take a look here, we actually saw consumer staples positive 0.8%. In a market where the S&P 500 goes down 2.7%, typically you see everything get sold off. We call it going to one because the correlation, they all go negative. That's not what we saw. Utilities did okay. It was negative, but consumer staples down up for the day. So it just shows you that this was more of a structural change in the markets. And this is positive for the market to start the week next week, or this week, I should say, positive. So this is a good sign. We're seeing that it wasn't all the sectors being affected negatively on Friday. Here's gold versus commodity. Gold and gold. Look at this takeoff here. Just amazing. All-time high, closed above $4,000. And a lot of people saying, well, it's oversold. Yes, it is oversold, but we still see buying into the sector, and we're starting to see people talk about currency debasement. Governments become more reckless in their spending and refuse to cut back spending, calling it investments and capital expenditures and things like that, and keep spending. And investors are just saying, well, where do we go from there? So we're seeing gold do quite well. Commodities really overall is on an equal weighted basis. Hasn't really performed that well over the last couple of years. So typically there is a pattern here where they go up and down together. This is a large gap. Maybe commodities pull up here. I think if the stock market does well, then I think that's what we could see that start to happen. Commodities picking up again. The fact that they're staying this low is indicative that maybe investors are feeling there's a recession perhaps coming up. They want to guard against that. So if we do see a recession, this would be more justified. But down the road, longer term, I do think that we'll probably see commodities actually close that gap longer term, perhaps over the next few years. Here's a chart for silver. Closed $50. We have to go back on this squeeze here, back in 2000 and going to 2011, 2012, or 2011, actually peak right here. So we have seen a strong move for silver, but look how far it can move. And that's true for all commodities. They can actually go up a lot higher than what people expect. Usually the reference is a stock market, but we can see a strong move. So yes, it has gone up a lot. And yes, it is overbought, just like it was back here as well, but it still can move higher. I want to show you a chart of Canadian dollar versus US dollar here. And so when this line is going down, that means the Canadian dollar is performing poorly relative to the US dollar and vice versa. What we can see here is we can see that the Canadian dollar since June which it was around 73.5, has gone lower, 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 and it's now at 71.4. Okay, quite a bit lower here. We've actually broken support around this level here and continued to move lower at this point. Now, don't forget, at the beginning of the year, we really went to 68, 69. So this is actually, we could see the same phenomenon taking place. So a lot of this is being driven by the US dollar. This was the result of US dollar weakness. This is not the result of US dollar weakness because US dollar really hasn't been performing well relative to world currencies. I'm going to show you that in a second, except for recently, and that could be an important sign. But this is made in Canada. We have done this to ourselves somehow. And also don't forget, tariffs are starting to have an impact. But Canadians, in Canada, we have a weak economy at this point. And so investors are basically saying, this is, we don't think the Canadian dollar is a good place to be at this point, while the other currencies of the world have done okay relative to the US dollar. Okay, so here's a chart or a graph from my website, alphamountain.com. If you take a look here, this is from 2004 to 2024. This is Canadian dollar versus CAD. And you take a look, the bar here is the average and the cross is the median. You can see that October tends to be one of the weaker months of the year. And likewise for November, both the median and average here. And you can see in November, the Canadian dollar is only being positive 38% of the time versus the US dollar. So we're seeing that downward trend for the US dollar. If we don't see energy pick up here, the price of oil pick up here a little bit, we probably will see Canadian dollar, according to the seasonality, actually head a bit lower here. Here's a graph of the US dollar versus the world currencies. And here's starting in January, this is every year, going back a number of years here. And you can see here for 2025, here's the end of the first half of the year. And this is a lot of graphs. And I put one out about this and talked about how poorly the US dollar had performed relative to world currencies. And I discussed this, why that took place, etc. But what we're seeing is we're starting to see some stability for the US dollar relative to world currencies. In fact, we're starting to see a little bit of a pickup here, which could be problematic. And there's just been this big narrative about how bad the US dollar is because the country's not run well, etc. But really, I mean, you have to compare it to other countries. France might have to get IMF help. They're a basket case. Economically, the UK is an absolute basket case. Germany's stumbling in and out of recessions constantly, only getting worse. They keep instituting really poor economic policies. Goes on. The list goes on. Japan just elected a new leader that will probably become the prime minister, and she's not good for the yen. So the dollar, you may say, well, I don't agree with what's happening in the U.S., but the dollar can do well. And Trump actually wants the dollar to go weaker. But the problem is how do you get it to go weaker? And at this point, the danger for the markets is we could see the U.S. dollar actually pick up here a little bit. So this whole narrative about how bad the US dollar is, let's go back here a little bit and let's take a look back in 2024. So here's the Dixie. We're using the Dixie. So relative to world currencies, it's currently at 99.2. So back in September of last year, it was just above 100, and then we saw that rally for the US dollar. And then in January, we saw the dollar go down. And I've talked about what happened here. So it really was coincidental of where the peak was. So if the peak was last year, the first half of this year wouldn't have been as bad. So the starting point was almost bang on for the beginning of the year for the downturn. We've seen this happen before, right? This is not a huge move in the world of FX. And really, right now, we're just below this 100 level. We were just above this in September. So just over a year ago, we're about where we are now. We went up probably too far and then came back down too far. So the US dollar is not dead yet. The danger is that it's going back up here. And watch out to break this real psychological level of 100. There's a lot of focus on this 100 level for the US dollar at the Dixie level. So if it does break above that and start to show some strength, that could cause some problems in the market. I think this is a factor that investors aren't watching at this time. And I think it's going to be important to track this because risk assets could run into trouble if we start to see the US dollar get too much strength. This is the Q3 earnings schedule for October. And you can see that the earnings start to really pick up, the earnings announcements. So on Tuesday, October 14th, here we are right here. This is going to be a big, big day here. We got Citi, BlackRock, JP Morgan, Goldman Sachs, Wells Fargo, all reporting. This is going to be very interesting. Now, what's interesting is, as I mentioned earlier, is the financial sector has been underperforming recently. And you would like to see the financial sector outperforming coming into the earnings because there's a lot of faith in the sector. This shows a little bit of lack of faith. Now, we may see big surprises and push the S&P 500 higher, but right now investors aren't that confident. So it's going to be really key to watch. Overall, earnings have actually been fairly strong, at least in Q2. We saw some fairly decent earnings, nothing really bad here, nothing that was flashing all sorts of red flags. So this week is probably going to set the tone for the market quite a bit. And we could see the market actually start to do well after last Friday if we get some strong earnings. And we could see a little bit of a rally despite October being a volatile month of the year. So the next couple of weeks tend to be volatile. We tend to see some volatility around the start of the earnings into late October. We'll have to see if volatility picks up. We did see volatility actually go up to about 21 on the VIX last week. So we'll have to watch out. I think Tuesday is going to be absolutely key for this week and really set the mood for the market overall. Thank you very much for watching this video. If you like this video, please click the like button below and also consider subscribing as well to the channel so you can get regular notifications for the videos coming out. Thank you very much.